What if there was an investment strategy that removed emotion from the equation, worked automatically in the background, and historically outperformed most active traders? There is. It's called dollar cost averaging. It sounds complicated, but it's actually one of the simplest investing strategies that exists. And it's the exact strategy that most financial advisors use for their clients without telling them it has a name. Today I'm breaking it all down: what it is, how it works, and why it's so effective for beginners. Dollar cost averaging, or DCA for short, just means investing a fixed amount of money at regular intervals, regardless of what the market is doing. So instead of trying to buy when the market is low and sell when it's high, you just invest $200 every month, or $50 every week, no matter what. That's it. You're not watching charts. You're not waiting for the right moment. You're just consistently putting money into the market on a schedule. Here's why this works so well. When prices are high, your fixed $200 buys fewer shares. When prices are low, your $200 buys more shares. Over time, this naturally means you end up buying more when things are cheap, and less when things are expensive, without ever having to think about it. Your average cost per share tends to be lower than if you had tried to time your purchases. This is why it's called dollar cost averaging. You're averaging out your cost over time. Let me show you this with a simple example. Say you invest $100 every month for 3 months. In month 1, the stock price is $10, you buy 10 shares. In month 2, the price drops to $5, you buy 20 shares. In month 3, the price rebounds to $8, you buy 12.5 shares. You spent $300 total and own 42.5 shares. Your average cost per share is $7.06, even though the price is currently $8. You're already in profit, even though the price hasn't fully recovered, because DCA had you buying more during the dip. Now compare that to someone who tried to time the market. They watched for 3 months before investing, then put all $300 in during month 3 at $8 per share. They bought 37.5 shares. You have 42.5 shares. You win, and you didn't have to watch the market, stress about timing, or make any judgment calls. You just stayed consistent. The psychological benefit is just as important as the mathematical one. Trying to time the market is stressful. You're constantly watching prices, second-guessing yourself, and feeling like you're missing something. Most people who try to time the market either buy too late at peaks, panic sell during dips, or stay on the sidelines in cash waiting for the perfect moment that never comes. DCA removes all of that. You set it up, automate it, and stop thinking about it. Research backs this up. Studies consistently show that most retail investors underperform the market index because they try to time it. They buy high and sell low because of fear and greed. Dollar cost averaging into a low-cost index fund beats the majority of active investors over a 10 to 20-year period. Not because it's magic, but because it's consistent, low-cost, and removes human error from the equation. Now, is DCA always better than lump sum investing? Actually, no. If you come into a large sum of money all at once, an inheritance, a bonus, research shows that investing it all immediately beats DCA about 2/3 of the time. Why? Because markets go up more than they go down. Being in the market longer is generally better. But lump sum investing requires the emotional ability to watch your portfolio drop significantly right after investing, which most people struggle with. DCA is better for psychology, even if it's occasionally worse for math. Here's how to actually set up dollar cost averaging today. Step 1. Open a brokerage account if you don't have one. Fidelity, Schwab, and Vanguard are all solid options with no account minimums. Step 2. Choose your investment. A broad market index fund like VTI or FXAIX is ideal for beginners. Step 3. Set up automatic recurring investments on whatever schedule works for your paycheck, weekly, bi-weekly, monthly. Step 4. Don't touch it. Let it run. Review once a year. That's the whole strategy. Dollar cost averaging into a diversified index fund over 10, 20, or 30 years is how most ordinary people build extraordinary wealth. It doesn't require you to be smart about the market. It doesn't require timing. It just requires consistency. And the earlier you start, the more powerful it becomes, because every month you wait, you're giving up compound growth that can never be reclaimed. Start now, even if it's just $50 a month. Your future self will thank you.